So you might have heard on the news that the government is buying billions in mortgage bonds. But what does that actually mean for you, and what does it mean for interest rates? So when the government, more specifically the Federal Reserve, buys mortgage-backed securities, it's trying to do one thing: lower mortgage rates. Mortgage bonds are where your 30-year fixed mortgages end up. So when demand for these bonds go up, the return investors need goes down, and that lowers mortgage rates. When the Fed buys billions of these bonds, it artificially boosts demand. That pushes rates down, at least temporarily. This is exactly what we saw in 2020. The Fed bought trillions of these mortgage bonds and rates dropped to record lows. But here's the catch. The moment the Fed stops buying or starts selling these same bonds, rates often shoot back up. So this is why rates feel so unpredictable. They're not just tied to inflation or the economy. They're also being pulled around by what the Fed is doing behind the scenes. So what should you do? If you're shopping for a home right now, don't try to time the market. Instead, get clarity on your monthly payment, know what your break-even point is, and put a plan in place to possibly refinance later if rates drop. And make sure you're working with a loan officer who actually tracks this stuff, watches the rate market daily, because it can impact your rate by thousands over time.